Hello and welcome to our Business Management Unit 7. We've been talking about business finance in this unit. So in this lesson, this is lesson 7.7, we are going to be talking about financial markets. So the objectives of this lesson are to compare and analyze the differences in the types of markets that businesses engage in to raise capital or to raise money. First off, let's start with talking about investment markets. Now, this is a market in which businesses and investors exchange capital and assets in the form of investment vehicles. There are different types of investments in an investment market. There are stocks, there's bonds, there's commodities, there's something called Forex, which I'll explain shortly. And there's real estate or REITs and cryptocurrencies. So, as I said, I'm going to talk about each one of these. We're going to talk about them individually. Now, remember, these are in markets where businesses and investors can put their money to gain capital, to gain money. So starting off with, let's go with stocks. Now, this is the buying and selling of shares or stocks or ownership in a company to raise capital via regulated exchanges. So they do operate on exchanges, such as the NYSE or the New York Stock Exchange, the NASDAQ, or OTC over the counter. Stocks play an important part because they allow money to flow through the economy. And some examples of stocks include Tesla, Microsoft, Apple, and many others. Next are bonds. These are transactions in which an investor loans money for a defined period at a pre-established interest rate. They're most often issued by corporations, municipalities, states, and even the federal government. Their purpose is to fund a project without allowing investors ownership. Government entities can't be owned. They are often low risk, low to medium return, but they are great when the economy is slumping, when it's slower. Commodities are transactions and speculations based on the price of raw materials. Futures shares are bought based on predicted future prices. Options are contracts to buy and sell at specific prices. With an option, you aren't required to actually purchase into the commodity, whereas with futures, you are. Some examples include corn, livestock, soybeans, lumber, oil, gas, carbon credits. It is a medium risk, medium return with potentially a high loss scenario. Next is Forex. This is actually foreign exchange. It's the investments based on the buying and selling between two currencies. That's where the foreign exchange comes in. It works by trading between the value or the future value of two currencies. For example, exchanging US dollars for the Chinese yuan, because the value of their currency is expected to increase. This is a medium to low risk, and not very often there's low returns. Next is real estate or REITs. These are investments in real estate investment trusts, REITs, where investors pool their money to purchase property. It is based on the value or the future value of homes or properties. Sometimes it is associated with renovators or flippers who work to increase the value of the property prior to selling. These can be publicly traded funds or private investment groups, these REITs. They vary in risk and return, and it depends on the market conditions. Finally is cryptocurrencies. These are investments in decentralized digital currencies where users exchange and manage crypto in online wallets. There are all types of digital currencies and coins. It is decentralized. The transactions occur between individuals. It's based on a blockchain technology, which is a method for chaining together transaction verifications. It's deregulated, meaning that there's little to no government oversight. It is high risk, but it is potentially high returns. So that is our lesson 7.7 regarding financial markets, where the objective it was to compare and analyze the differences in the types of markets that businesses engage in to raise capital.